one of the world's biggest LiDAR manufacturers, their stock price has crashed. And I mean, absolutely collapsed. It's catastrophic. We're talking billions and billions and billions of dollars of losses.
Imagine entire industries, once thriving and seemingly unstoppable, crumbling almost overnight. Factories close, jobs vanish, stock prices plummet, and companies that once symbolized innovation and prosperity suddenly become cautionary tales. The collapse of major industries may seem sudden, but beneath the surface lies a complex web of factors: financial mismanagement, technological disruption, shifting consumer behavior, and global economic forces that turn booms into busts faster than most people realize. Today, we'll uncover why industries rise, thrive, and sometimes vanish almost instantly, reshaping economies and lives in their wake. One of the primary reasons industries collapse is technological disruption. Innovations can render existing business models obsolete almost overnight. Consider how the rise of digital streaming destroyed the DVD rental market, or how smartphones upended traditional camera and GPS companies. Businesses that fail to adapt quickly enough are left behind, their once loyal customers migrating to more agile competitors. In many cases, the collapse is sudden not because the industry was failing, but because the technology shifted the rules entirely, turning a market leader into a struggling relic virtually overnight. Consumer behavior is another critical driver. Industries thrive when they meet demand, but when preferences change, even dominant players can falter. Shifts in tastes, lifestyles, and expectations can undermine products and services that were once indispensable. The fast fashion, brick-and-mortar retail, and print media sectors have all experienced this phenomenon. Companies that misread consumer trends or fail to innovate in response risk sudden collapse. Consumer choice may appear random, but in reality, it's a powerful force capable of reshaping markets overnight. Globalization adds a layer of complexity to industry stability. Outsourcing, international competition, and trade dynamics can destabilize once prosperous sectors. Industries that were insulated by geography or regulation may suddenly face competitors operating at lower costs or with more advanced technologies. A local monopoly can evaporate when global players enter the market with scale, efficiency, or pricing power. Industries that fail to account for these forces often experience rapid decline, even if domestic demand remains strong. Financial mismanagement is a surprisingly common culprit. Industries often expand rapidly during boom periods, taking on debt, over-leveraging, or engaging in risky speculation. When market conditions shift, cash flow tightens, and companies are unable to service debt or sustain operations. The financial crisis of 2008 revealed how overextended sectors from housing to banking could collapse almost overnight. Industries are vulnerable when growth outpaces sustainable financial practices, turning prosperity into catastrophe in months or even weeks. Regulatory changes and government intervention can also precipitate rapid industry decline. New policies, environmental standards, or taxation laws can make existing business models unprofitable. Industries that rely on heavy resource extraction, chemicals, or carbon-intensive production are especially vulnerable. Even incremental regulatory changes, when applied across an entire sector, can drastically alter profitability. Sometimes industries collapse not because demand vanishes, but because legal and regulatory frameworks suddenly make operations unsustainable. Supply chain disruptions have become increasingly impactful. Natural disasters, pandemics, or geopolitical conflicts can cut off access to raw materials, energy, or logistics networks. Industries dependent on complex, global supply chains, automotive, electronics, pharmaceuticals can find themselves paralyzed almost overnight. Even temporary disruptions can trigger cascading effects: production halts, contract breaches, layoffs, and stock declines. The sudden nature of these disruptions makes them appear like an industry collapse, even when the underlying demand remains intact. Market saturation is another hidden threat. Industries often experience explosive growth until they hit a ceiling when demand peaks and expansion slows. Companies that fail to innovate or diversify may find profits shrinking rapidly. Overproduction, competition, and price wars accelerate the decline. This is why sectors like consumer electronics or fast fashion, which appear unstoppable at their peak, can suddenly experience shrinking revenues and industry contraction, catching investors and employees off guard. Corporate culture and leadership play a decisive role as well. Industries depend on innovation, strategy, and adaptability. When companies cling to outdated management practices, resist change, or fail to anticipate trends, they risk collapse. Leadership failures can magnify other pressures, financial, technological, or competitive, turning a sector-wide challenge into an existential crisis. Industries that appear stable for decades can fall apart because decision-makers misread the signals or underestimate the speed of change. Investor behavior and speculative bubbles often accelerate boom and bust cycles. Industries can appear profitable beyond reason when investors pour money in, inflating valuations and encouraging reckless expansion. Once confidence falters, investment retreats, markets contract, and industries that seemed unstoppable implode. The dot-com bubble is a classic example. Companies with little to no revenue achieved astronomical valuations, only to collapse when reality caught up. Investor psychology can therefore turn gradual decline into sudden collapse, amplifying underlying vulnerabilities. Innovation within industries themselves can be a double-edged sword. While new technologies can drive growth, they can also cannibalize existing products. Automotive manufacturers, for instance, face disruption from electric vehicles. Energy companies confront renewable alternatives. Industries that fail to manage internal disruption risk losing market relevance. Collapse is often fastest when companies underestimate or resist innovation, allowing competitors to capture the future while the established players are left scrambling. Global economic shifts, recessions, interest rate changes, and trade disputes can trigger sudden collapse. Industries are interconnected. A shock in one area reverberates through multiple sectors. For example, the 2008 financial crisis caused rapid contractions in housing, construction, banking, and retail. These collapses appear sudden, but they are often the result of accumulated vulnerabilities exposed by a larger economic shock. Industries are rarely self-contained. They are nodes in a complex global network, sensitive to shifts that can cascade in unexpected ways. Consumer trust and reputation are fragile yet critical. Industries built on credibility, finance, healthcare, food, and technology can experience near-instant collapse when trust erodes. Scandals, safety failures, or ethical lapses can trigger consumer boycotts, regulatory action, and investor withdrawal. The speed at which public perception changes can turn thriving industries into cautionary tales, demonstrating that market dynamics are shaped as much by perception as by fundamental economics. Competition is relentless and unforgiving. Industries thrive when a few dominant players operate efficiently, but new entrants or disruptive business models can upset the balance overnight. Ride-sharing apps, streaming services, and e-commerce platforms exemplify how fresh competitors can destabilize traditional industries. Market share shifts rapidly, and companies that fail to adapt may find themselves irrelevant almost instantly. The lesson is clear. In modern markets, dominance is temporary, and industries must continuously evolve or face collapse. Mergers and acquisitions can also accelerate industry contraction. When dominant players consolidate, smaller competitors may be squeezed out, supply chains realigned, and market structures transformed. While this is often a strategic choice for growth, the unintended consequence can be sudden collapse for less agile companies. Industries are vulnerable when consolidation reshapes competitive dynamics faster than adaptation allows. Technological dependency is another subtle vulnerability. Industries reliant on outdated or proprietary systems can collapse when more efficient alternatives emerge. Legacy infrastructure, software, or processes can become liabilities, forcing costly upgrades or complete overhauls. Companies unable or unwilling to invest in modernization may experience abrupt declines as competitors gain efficiency, reduce costs, and capture market share. Finally, global crises from pandemics to climate events highlight how fragile industries can be. Unexpected shocks can rapidly disrupt operations, consumer demand, and supply chains. The COVID-19 pandemic illustrated how quickly travel, hospitality, retail, and manufacturing sectors could collapse despite years of growth. Industries that seemed resilient suddenly faced existential threats, emphasizing that even the most successful sectors are vulnerable to unpredictable external forces. The combined effect of these factors explains why industries can collapse seemingly overnight. Technological disruption, consumer behavior, globalization, financial mismanagement, regulation, supply chains, leadership, investor behavior, innovation, economic shifts, competition, mergers, legacy dependency, and crises all interplay to create fragility. Collapse is rarely the result of a single event. It is the outcome of accumulated pressures that suddenly reach a tipping point. Understanding these dynamics helps us see patterns behind booms and busts, revealing that industries are complex ecosystems rather than static entities. From boom to bust, industries illustrate the fragility of markets in a complex world. Success is never permanent, and dominance can vanish in months. The companies, workers, and economies that thrive tomorrow are those who understand the hidden forces shaping markets today. The next time a once booming industry collapses overnight, remember, it wasn't random. It was the inevitable result of interconnected pressures, structural vulnerabilities, and a world that moves faster than anyone expects.